if you're serious about navigating the coming AI market bubble and positioning yourself to profit, here's a practical step-by-step checklist to guide your investment decisions. Grab your notebook or open a notes app because these are actionable points you can use right now. Start by asking, does this company have a real AI product or solution, or are they just using buzzwords? Dig into their white papers, product demos, and consumer case studies. Do they have live deployments? Are their clients real? And do they have testimonials or published results? If you can't find evidence, that's a red flag. Don't be swayed by glossy presentations alone. Look at the company's financial health. Are they generating consistent revenue, especially from AI products? What's their R&D? What's their R&D spend as a percentage of revenue? Are profits growing or are they burning through cash just to chase headlines? Companies like Nvidia and Alphabet have clear, peer-reviewed annual reports and strong fundamentals. Use online tools like Yahoo Finance, Morningstar, or your broker's research platform to analyze these numbers. Is the technology being used at scale? Are there major partnerships? For instance, when you see Microsoft integrating OpenAI's models into its suite of products, that's a sign of real adoption. Compare this to companies with only pilot projects or press releases. Substance beats speculation every time. Research the founders, board members, and executive team. Do they have a track record in AI or related industries? Are they serial entrepreneurs with a history of success or newcomers riding the trend? Monitor inside buying and selling. Are executives buying more shares or are they cashing out as prices rise? Have insider selling, even during hype, can be a warning sign that the team doesn't believe in the long-term value. Don't go all in on a single AI stock or sector. Diversify across industries and geographies. ETFs like Global X Robotics and Artificial Intelligence, BOTZ, or iShares Robotics and Artificial Intelligence, IRBO, offer exposure to a basket of companies. This way, you minimize the risk of a single company imploding. Always use stop loss and take profit orders. Decide in advance how much you're willing to lose or gain before you exit a position. Emotional investing leads to poor decisions. Discipline and automation keep you on track. The AI landscape changes fast. Subscribe to industry newsletters. Follow those leaders on LinkedIn and Twitter. And set Google alerts for major companies or tech breakthroughs. Regulation, for example, can change the game overnight, so stay agile. Schedule monthly or quarterly check-ins on your portfolio. Are your AI investments performing as expected? Has the competitive landscape shifted? Don't be afraid to rebalance. Sometimes the best move is to take profits and move on. No one has all the answers. Engage in investment forums, watch expert interviews, and ask questions. Commenting below is a great way to start. Let's build this knowledge together. Let's talk about risk. Every investment carries risk, but bubbles magnify it. Here are a few key principles. Never invest more than you can afford to lose. Keep a cash reserve for buying opportunities after corrections. Be wary of margin or leverage. It can multiply losses as quickly as gains. Separate your core, long-term holdings from speculative plays. Remember, sometimes the best move is to do nothing. Wait for clarity rather than chase every hype waves. If you follow this checklist and these risk management principles, you'll be far ahead of most retail investors. You'll have a system, not just hope, guiding your decisions. Let's take a moment to feature some stories from our community. Many of you have reached out, sharing both wins and lessons learned in the AI investing space. For example, Sarah, a regular commenter, shared that she jumped into an AI stock because of a viral TikTok video. It soared for a while, but when earning missed expectations, the stock dropped 40%. Sarah admitted she didn't do her homework on fundamentals and learned the hard way about volatility in hype driven markets. Her takeaway: hype can make you money fast, but research and discipline keep you from losing it even faster. Then there's Michael, who took a diversified approach. He invested in an AI ETF, spread his risk across dozens of companies, and used stop loss orders for protection. When a few of the stocks tanked, his portfolio held up because the winners outpaced the losers. Michael's discipline and risk management paid off, reminding us that slow and steady can really win the race.